Welcome back to the Deep Dive. Today we are taking a deep breath and looking straight into the financial engine room of South Africa's most successful families.
We really are.
We're talking about advanced wealth structuring. Specifically, how they use things like holding companies and trusts to essentially become their own bank.
And this isn't just about saving a bit of money, it's really about control. Our mission today is to give you the blueprint, to unpack the structures that make sure the money you earn stays within your ecosystem.
Right.
So it's compounding and working for your kids, for your future generations, rather than just constantly leaking out to the banks.
And that leakage, I mean, we have to start there because the scale of it is just shocking. It's the motivation for all of this.
It really is.
Okay, so look at this example from our sources. If you, listening right now, take a standard R3 million loan over 20 years, the rate is, say, 13.75%, which is totally normal. It's prime plus a bit. The total interest you hand over to the bank, it's R6,563,280.
Let that number just sink in for a second. Over 6.5 million rand.
Staggering.
That is the cost of dependence. It's a pure wealth transfer from your family's balance sheet straight to the bank's shareholders. So you needed $3 million for an opportunity, but you actually paid almost $9.5 million for it.
So our question for this deep dive is simple. What if you paid that R6.5 million to yourself?
Exactly.
What if that interest just cycled back into your own investment pool?
That is the entire game. That's the power of this structure. At its core, your holding company can function as your own, personal banking license. It generates, it accumulates, and then it lends capital to businesses you already own.
But it needs protection.
It absolutely needs a protective framework. For it to be robust, protected from creditors, structured for the long term, that's where the family trust comes in. The trust usually sits right at the cup, owning the most critical asset of all, the holding company shares.
Okay, let's unpack that. The holding company banking system. You mentioned speed, certainty, and cost. Let's make that tangible for everyone. Why is this model so much better than just, going to the bank?
It's an immediate competitive advantage. I mean, time is money, right? And certainty over your capital is power.
Sure.
If you apply for a business loan in South Africa today, the sources are clear. The process takes anywhere from 2 to 4 months. That's chasing down financials, waiting for credit committees. Just endless bureaucracy.
And what happens if you need to close the deal quickly? You see a great opportunity.
Yeah, lose the deal. It's that simple. Now compare that to the holding company route. If your entities are set up properly, the internal approval, which is just a board resolution and a loan agreement.
How long did that take?
3 to 5 days.
Wow.
We saw that Naidu property case study. She closed a time-sensitive acquisition in 12 days. Just 12. Because she was borrowing from her own internal structure. The capital was just there, ready to go.
That speed is completely transformative. And then you mentioned certainty. Banks are tightening their belts. In 2024, they approved only about, 42% of business loan applications?
Less than half. Inside your own ecosystem, if the capital is there, the approval rate is 100%. You control the lender and you control the borrower.
Yeah.
That certainty lets you plan for growth. You know the capital will be there when you need it.
Okay, now for the engine, the cost saving. A bank charges prime plus 2 or 3%, which gets you to that 13.75% or even higher.
When your holding company is the lender, you still have to comply with SARS rules. We'll get into that. But you can set the rate at prime or just a little bit above, say 11.5% to 12.5%.
And you keep that spread.
You keep that crucial 1 to 3% spread inside the family structure. The operating company gets a tax deduction on the interest it pays, and the interest income cycles right back into the holding company.
Ready for the next deal.
Ready for the next deal. That is capital retention in action.
This sounds amazing, but
Yeah.
how do you actually feed the holding company? How does it build up, 10 or 20 million in lending capital without the owner having to pay massive personal income tax first?
Now that is the genius of the compliance strategy. It's called retained earnings accumulation. So let's imagine Sipho. He owns a very profitable operating company.
Okay.
That company makes R2 million in profit this year. If Sipho decides to take, say, R1.5 million of that as a personal dividend, he's going to get hit hard. The maximum personal income tax rate may be up to 45%.
So a huge chunk of that is just gone, straight to the tax authorities. How does the holding company legally get around that?
So instead of paying himself, Sipho instructs his operating company to declare that R1.5 million dividend directly to its shareholder, which is the holding company.
Not him personally.
Not him personally. And this is where South African tax law is your friend. It's under the intercompany dividend exemption. That's Section 10(1)(k) of the Income Tax Act.
Okay, so tell us simply, what does that section do?
It states that if a South African company gets a dividend from another South African company, that dividend is exempt from tax.
So it's tax-free.
100% tax-free. That R1.5 million lands in the holding company untouched. It is now pure lending capital, secured inside the structure, ready for quick, certain deployment. You do that year after year, you've just built your own private fund.
That is a massive shift in mindset. You're going from being a consumer of capital to a distributor of capital.
Mm-hmm.
But if the holding company is doing all this heavy lifting, why do we need the family trust? Now, this is where it gets really interesting for me.
That's an excellent question. The holding company is your engine, right? It's powerful, but it needs a protective chassis around it. That chassis is the trust.
Okay.
The holding company is great for tax-free capital accumulation, but it's still a company. Its shares are personally owned by Sipho, so if Sipho gets sued or he goes insolvent, his holding company shares are exposed.
And that's what the trust solves.
Exactly. The trust is optional, but, it's so highly recommended because it owns the shares in the holding company. It creates a legal separation. In the South African context, a trust is a legal arrangement where assets like those shares are transferred to trustees.
And the trustees manage them for the family, for the beneficiaries.
Correct. The trust is an entirely separate legal entity from the founder, governed by the Trust Property Control Act.
That's separation.
Yeah.
That's the key to asset protection. What exactly are we protecting the assets from?
From personal risk. Plain and simple. When the trust owns the shares, they are insulated. If the founder has a bad day in another business and creditors come knocking, or if they face personal legal claims, the shares of the holding company, which holds all the family's capital, are usually untouchable. It's a firewall. And if it's structured right, those assets are also protected from division in a personal divorce.
Okay, now we have to talk about the tax paradox, because this confuses a lot of people. The standard advice you hear is that trusts are taxed really highly.
They are.
Income retained in the trust is taxed at a flat 45%. Capital gains tax is at 36%. How can that possibly be tax efficient?
That is the critical strategic trade-off. You have to see the long game. We accept a higher annual income tax rate, that flat 45%, in exchange for two invaluable long-term benefits.
Which are?
Generational preservation and the almost complete elimination of estate duty.
Okay, explain that trade-off. Why would I pay 45% now?
Because the goal isn't minimum tax this year, it's maximum wealth transfer in 30 years. When the trust owns the assets, those assets are removed from the founder's personal estate.
I see.
Which means when the founder passes away, the massive value of that holding company is not subject to estate booty, which is 20 to 25% on assets over R3.5 million. You sacrifice a little bit on annual income tax to save millions in death tax.
That makes perfect sense. And you also get continuity after death.
Yes, absolutely. When wealth is held personally, an estate can get tied up for months, sometimes years, with the master of the high court. Probate, delays, everything grinds to a halt.
Nightmare for a running business.
A total nightmare. But if the trust owns the holding company, the trust just keeps going. It operates smoothly, completely bypassing those probate delays. The trustees just carry on. It's seamless continuity.
So we've built the engine. We've built the protective shell. Now, the non-negotiable part. Compliance. The sources are so clear on this. One mistake can wipe out everything.
This is where the whole thing can fall apart. This is where rigor is everything. SARS is highly suspicious of internal loans between related parties. They want to make sure these aren't just disguised dividends or donations to avoid tax.
So how do you prove to SARS that a loan from your holdco to your opco is legitimate?
Every single aspect must mirror a real arm's-length commercial deal. Let's start with arm's-length interest rates. The rate has to be what a bank would charge a total stranger.
So prime or a little higher.
Exactly. The source suggests 11.5% to 12.5%. If you set the rate too low, say 5%, SARS will reclassify the transaction immediately.
And what happens if they do that?
Well, if they call it a donation, for example, the borrowing company loses its tax deduction on the interest. The holding company could face new taxes, and the founder could be hit with massive penalties. All those benefits, gone.
So the paperwork isn't a formality, it's the foundation. What specific documents do you need?
You need a paper trail for everything. First, a written, formal loan agreement for every single advance. It has to detail the terms, the repayment schedule, everything.
Okay.
Second, you need board resolutions, signed, in both companies, the lender and the borrower. stating the board approves the loan. And critically, you need proof of regular interest payments actually being made.
Treat it like a real bank loan.
You have to. Which brings us to the long-term view. We are talking about building multi-generational wealth here.
Right.
This whole structure is about wealth preservation. It's about clear succession planning. The trust remains stable. It provides continuity. It outlives the founder. It's built to last.
This is clearly not a weekend DIY project.
Right.
I mean, understanding the theory is one thing.
Yeah.
But implementing it legally, compliantly in South Africa, that's another story.
And that is the critical compliance point we keep coming back to. You need specialized expertise. Navigating the Trust Act, SARS compliance, the documentation. It requires very specific knowledge.
So this is where expert advice becomes, as you say, the missing key. We're talking about the role of a trust consultant, someone like Lumka Sturman, who specializes in these exact structures.
The value a specialist provides is just huge. They make sure the structure is legally sound from day one, and more importantly, that it stays compliant. They give you clear, actionable advice tailored to your goals.
And they simplify it.
They simplify the complicated legal and financial jargon, yes. They translate the theory into practical, compliant steps.
And it's a holistic approach, right? It's not just about the setup. Because life changes.
Yeah.
Regulations change. The trust has to be a living document.
Absolutely. A trust needs ongoing management, and it needs periodic review, every 3 to 5 years, maybe. A consultant handles that setup, the ongoing management, and the review. It just gives the founder peace of mind that their legacy is secure.
So who should be looking at this level of structuring? Who should be talking to a consultant?
Any established business owner with significant retained earnings. Any family looking to protect valuable assets, say over a few million rand. Or anyone really trying to minimize estate duty and ensure smooth business succession. It's about empowering your family for generations.
Okay, let's wrap this up with the core takeaway. The mission here was to show you how to move from being a borrower paying that R6.5 million out to being a lender, retaining that capital inside your system.
The compounding effect is enormous over time, but the biggest benefit is always that speed and certainty. When you can deploy capital in days, not months, you seize opportunities. Your competitors, who are shackled to the banks, simply can't touch.
And we'll leave you with this really powerful thought. It's a quote from Jabu Mathimbu, a business owner from our source material. He said, "I wasted 15 years begging banks for money I already had in my own companies."
Think about that. The biggest risk isn't the cost of setting this up. It's the cost of delay.
If you are currently paying R50,000 a month in interest to a bank, that is R600,000 leaving your family's ecosystem every single year.
Compounding the debt of dependence.
So if you're ready to explore how to properly structure these complex wealth-building mechanisms, the holding company engine, the trust framework, or both professional guidance is, well, it's absolutely essential.
For those of you who are ready to stop enriching external shareholders and start building your own capital engine, your own legacy, you can find more resources and information at the website of the trust consultant we mentioned. It's www.lumkasterman.com.
Take control of your capital. Start that process of structural change today.